My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. After a big run, you always hear that there are just too many bulls, too much excitement, too much optimism, that we've been lulled into a false sense of security. You'll hear it even after a sedate day like today, where the Dow, which was down most of the day, gained 69 points. S&P climbed 0.29% to an all-time high, I should add. Getting bored by those? And the Nasdaq advanced 0.22%. But here's my question. What exactly are we too bullish about? I mean, are there individual stocks, sectors that have gone crazy? You know what? I always like to break things down. Let's take them one by one, as opposed to just making a sweeping and wrong judgment. Are we really being irrationally exuberant, say, with the banks, large sector of the market? After last week's run, tough to tell. When you see major dividend and buyback boosts after, of course, a federal government review, investors, I think, have good reason to get more positive. I mean, how can you feel the same way about the stock of Goldman Sachs when the company just increased its payout by nearly 50% and rolled out a $7 billion buyback? Hey, that's more than 9% of the shares outstanding. In the end, the financials simply got better after the stress test results. And even here, I can't say there's that much enthusiasm. These stocks are darn cheap. Are we too bullish about healthcare, another large sector? Dream on, partner. The managed care stocks have become proxies for the candidacy of Joe Biden, the most moderate Democrat on healthcare, who has a chance of winning. When Biden does badly in the debates like he did last week, these stocks go down. As for the drug companies, I mean, today we got still more articles about how they're price gouging. This whole sector is political football until we get more clarity on the primaries. For now, though, the idea that investors are too bullish on healthcare, well, that is nuts. Retail. Oh, come on. You know, there are really only 4 brick-and-mortar retailers. There's like 100 stocks, but 4 that are working: Walmart, Target, Costco, and Home Depot. They're big enough to absorb the tariff costs and to compete against Amazon. You can argue that their stocks are expensive, but the rest of retail, all right, I've got a kind of a frog in my throat, but I'm going to have to kind of give you a little Neil Young here. Helpless, 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 helpless. Neil Young. What else? The cyclicals remain trapped by China. There are a couple of industrials that seem unstoppable. I'll give you Honeywell and Ingersoll Rand. However, the rest of the group pretty much refuses to budge. Once again, with a few exceptions, nobody's excited about this group. I mean, the steel stocks acted better before the tariffs that are supposed to protect them, for heaven's sake. Today's lack of enthusiasm for the trade truce sure didn't help. The most cyclical companies, the papers and chemicals, they have become some of the worst performers I have seen in my trading career. All right, how about the once red-hot aerospace sector? I mean, after hanging in there for months, Boeing's, well, it's a dog. Oil, this is a group you can't even give away. I take BP, please. Had to. Here's a company that had a tremendous quarter, good growth, solid. It's got 5.9% yield. Yet the stock seems cemented at 42, except when it falls to 41, that is. The oils are unbearable to own. This group, as my late mother would say, is from hunger. Airlines, hit or miss. Sure, the rails are acting better, but that's because they're all becoming better operators, not because the businesses have suddenly decided to be revalued as commerce plays. How about FedEx and UPS? These former market leaders have turned into losers. Tariffs. Let's see. Are we too bullish about the auto industry? Come on. I mean, you've seen those valuations? These stocks are trading at ridiculously low price points, which means that people have zero faith in the future. And no wonder. General Motors just reported still one more negative set of quarterly numbers. Is that you don't ever know? It's like one of those stocks is like, I don't have to look at it. It's probably 38. And so where does the argument say that we're too bullish? It comes from tech, where we do have some outrageous valuations. This morning, RBC downgraded 2 real high flyers, Trade Desk and Roku. We've had one. Both stocks were able to bounce right back after opening lower. Roku stock ended up having a big day, rallying $1.68. Trade Desk fell almost 9 points and then finished in the black. This is what I'm talking about. So it's not like we're going crazy. Look at the internet stocks, Facebook and Alphabet, and we have more on Facebook there, are historically low valuations. Yes, the ancillary plays, Shopify, Twilio, and Etsy, they're pricey. But that's because investors are always going to be willing to pay up for what is rapid growth that's sustainable. Semis, I know, controversial. This group just had the beatdown of a lifetime, though. And while they bounced yesterday in the trade news, particularly the rollback of the Huawei blacklist, they came right back today. It's tough to value newly minted IPOs like Zoom Video or The Real, even Uber and Lyft, beyond me. The whole class of 2019 is way too expensive in my eyes, and I think these stocks are indeed vulnerable. However, IPOs aren't a sector. They're just a subset of one group, with Beyond Meat thrown in for good measure, even though it's not really a tech stock at all. Look at the rest of tech, though. Intel, cheap as I've ever seen it. AMD's expensive, but not if the numbers come through, for heaven's sake. Micron sells for 6.4 times earnings. Come on. That's one of the cheapest stocks I've ever seen. Software's got some pricey ones. I think some of the cloud kings are vulnerable. Splunk, ServiceNow, on fire every day. Salesforce, a lot of insider selling. A Workday, down, up 7 yesterday. All right. Adobe, they could plummet from these levels, and they still wouldn't be cheap. But that's been true for years, people. It's not even noteworthy. These cloud stocks have permanent overvaluations with periods of painful swooning that you had to buy. I think they have potential to go higher, maybe much higher if the economy shows signs of slowing and investors crowd into the consistent growers. But there's always a chance something goes wrong and they all blow up off of one. Remember a couple years ago when LinkedIn blew up the same day as Tableau did? Well, Tableau software, well, think about it. Tableau software ended up being bought by Benioff at Salesforce, and the LinkedIn was bought by Microsoft. You can say the same thing for every software stock as a service. Any SaaS stock that gets hit is going to get bought. All right, here's one, fintech. To me, financial technology is the most overvalued part of the market. Visa, PayPal, American Express, MasterCard. But they're viewed as secular growers, so what? Every time they get hit, buyers come out of the woodwork. You want to go against FleetCor? Remember I recommended it, some short seller said it was no good? Man, I think he's still on I-95 getting run over by 18-wheelers. Big cap techs, let's go over them, all right? This is important. Amazon, yes, vulnerable. Microsoft, after this run, vulnerable. Netflix, vulnerable. Apple, potentially vulnerable. These are the big ones that could potentially get pummeled, especially if the trade war heats up against Apple and gets caught in the crossfire. However, I think the deal the president just made is a major win for these guys. I wouldn't sell Apple. Still, when you look over the whole market, the idea that we're too bullish, it does not hold up under close scrutiny. While there are some overvalued stocks, overall people, I think, are pretty skeptical, regardless of what polls say. Bottom line, feel free to pull in your horns because you think there's too much enthusiasm. I'm not seeing it. As far as I'm concerned, there's too much exuberance in one particular subset of expensive tech stocks. But other than that, you're boxing with phantoms. Stan in Florida. Stan.
Hey, Jim.
Stan.
I'm an owner of the Dow-DuPont merger, and they've spun off all three divisions. Dow's doing okay. Corteva looks like it's going to have a rough year because of the Midwest flooding and so forth.
Right.
And DuPont today got hit with a big lawsuit from Chemours saying that they totally, almost fraudulently, mislabeled their amount of reliabilities going forward. Is this a deal breaker?
I thought that DuPont was scrubbed clean, and that will not be a big clawback. The best one of those three is DuPont. You know your stuff, man. Corteva, the ag business is tough right now. You buy Agco if you want to do it. The one that did surprise me is Dow, holding up at 6, but it's got a bottom. Jim Fitterling, always welcome on the show. Now I need to speak to Eileen in my home state of New Jersey. Eileen.
Hi, Jim. Good evening. My question tonight has to do with automatic data processing.
Yes.
The ticker is ADP.
Right.
I've always been a big fan of ADP. However, I read an article last night after close of business, and apparently some institution is offering a block of 8 million shares. The stock is down 4%. Do you think someone is
We
trying to
couldn't
raise
find
some
out what
cash,
the heck
or
was
something
going on there.
on?
Now, first, Eileen, I'm so glad you brought this up because I don't know who sold the stocks, not the company. Carlos Rodriguez is amazing. The company's incredible. That's why I said when it was down to 159, I just said, pull the trigger and buy. Buy. And I got to tell you, even at 161, it's still a buy, regardless of who's the seller. All right, sure, some stocks are way too expensive right now. I get that. I gave them to you. But the majority of sectors are pretty much hated and cheap, and come on. Hey, Mad Money tonight. What's driving some of the moves in the S&P? I'm going to go off the charts to find out. Then the trade war with China may have cooled this weekend, but tonight I'm revealing which stocks are the biggest winners from the Huawei détente and, of course, the biggest losers, the dangerous ones. Hey, and forget reefer madness. It's mall madness when it comes to cannabis. Somebody's doing well in brick and mortar. I'm talking to the company that's helping CBD go mainstream. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.